Welcome to PIMCO Pod. In this episode, we discuss how marking asset prices more frequently won't fix transparency and accuracy issues in private credit, which still lacks a market-based method of determining prices. Stay tuned after the conclusion of the podcast for additional important information. Daily pricing is not daily liquidity, by Lotfi Karui. Within private credit, attempts to increase liquidity, the ability to buy or sell an asset quickly, in size, and at prices reflecting fundamental values, are welcome developments, in our view. Yet until these efforts address the market's inherent structural constraints, including a lack of true price discovery, they will only increase the perception of liquidity without truly improving liquidity. The debate over daily pricing in private credit portfolios has evolved from a narrow accounting question into a proposed remedy for the market's dispersed and often stale valuations. Two related developments have driven this shift. First, price mark dispersion for loans held across multiple business development company (BDC) portfolios has widened sharply in recent quarters. By year-end 2025, marks for the same instrument were, on average, about 5 points apart. These gaps are difficult to reconcile with the notion of arm's-length fair value determinations for identical assets. To be sure, some dispersion is inevitable under the Financial Accounting Standards Board's FASB Level 3 accounting, where managers have latitude over assumptions, discount rates, and comparables. But the magnitude of recent dispersion suggests that the absence of observable transactions is no longer a benign feature of the market. In some cases, reported net asset values, NAVs, appear to reflect managers' views more than market clearing values. For context, we estimate that 83% of loans held by at least two BDCs are priced within a 2-point range. For the remaining 17%, the distribution is notably skewed to the upside. The second development is the rapid growth of evergreen vehicles that offer periodic subscriptions and redemptions at NAV. Unlike closed-end drawdown vehicles, where stale or imprecise marks are mostly an accounting issue, NAV sets the transaction price in a semi-liquid vehicle. Stale or highly dispersed marks allow early redeemers to receive a windfall or suffer a haircut at the expense of remaining investors. While gates that limit investor withdrawals can mitigate the risk of extreme and uneven treatment, they do not eliminate the underlying issue. More frequent pricing is not more accurate pricing. Daily pricing is not only an incomplete answer to these issues, it may even exacerbate them. Daily pricing is not price discovery. At best, it adds marginal transparency and some reputational pressure that may reign in the most extreme mark outliers. But on its own, it is not a meaningful structural reform of the private credit market. Any manager can produce a daily price estimate using an imputation model based on discount rates, comparable spreads, and borrower-level credit metrics. But that is simply a higher frequency application of the same Level 3 valuation process that already produces wide dispersion in quarterly BDC marks. The same loan can be marked 5 or even 10 points apart because managers are not anchoring valuations to the same inputs, and, more importantly, because no one is required to transact at the stated price. If 3 BDCs rely on different model inputs on a quarterly basis, they will do so daily as well. The result would be dispersion at a higher frequency, potentially with more noise, not less. The core problem, therefore, is not frequency, it is methodology and observability. Why true price discovery in private credit remains a high bar. Broadly speaking, there are two pathways to address valuation dispersion and stale marks in private credit. The first is incremental and more immediately attainable. Greater reliance on third-party validation, independent valuation agents, standardized methodologies, and tighter governance, which would help narrow differences in how assets are priced across managers. The second is more transformative. Genuine transaction-based price discovery anchored in a functioning secondary market. The distinction matters. Third-party validation can improve consistency, but it does not fully resolve the core issue. These marks are still at their foundation, model-driven rather than market-cleared. True price discovery requires observable transactions and continuous two-way flow. Yet the bar for achieving that outcome is significantly higher than commonly assumed. Even setting aside the fact that many participants have limited economic incentives to promote liquidity in their own assets, several structural constraints would need to be addressed. 1. Standardization of instruments and data. Private credit lacks the common language that underpins liquidity in public markets, including standardized identifiers, consistent documentation, and uniform financial reporting. This fragmentation limits comparability across assets and makes it difficult for participants to underwrite trades at scale. Without a credible foundation for benchmarking and relative value analysis, secondary activity risks remaining episodic and bespoke, more akin to a balance sheet management tool than a true market. 2. Settlement and operational infrastructure. While discussions often gravitate toward electronic trading platforms or trace-like reporting, the more immediate constraint is far more basic. Settlement. Today's trade settlement processes are slow, manual, and operationally intensive. Until settlement becomes faster, more predictable, and scalable, turnover will remain inherently constrained. In other words, trading velocity is less a function of pricing transparency than of post-trade frictions. 3. Transferability constraints. Many private credit agreements retain borrower consent provisions for loan transfers. This introduces a fundamental friction with no real public market equivalent. In practice, it creates uncertainty around execution timelines and transfer certainty, two conditions that are essential for any market seeking to support regular institutional trading activity. 4. Information asymmetry and conflicts of interest. The information barriers facing secondary buyers in private credit go well beyond deal documentation. Access to borrower-level data is often gated by non-disclosure agreements, NDAs, and disclosure frameworks are neither standardized nor continuous. But even where some price transparency exists, such as occasional bid-offer indications, those quotes are frequently sourced from affiliates of the originator or the manager itself. This introduces a structural conflict of interest. The entity providing the price signal may also be the party with the greatest economic stake in where that asset is marked. For a secondary market to function credibly, pricing needs to be not just available, but transparent, independent, and objective. Without that, participants cannot distinguish between genuine market clearing levels and marks that serve the commercial interests of the price setter. This is the inverse of the regime that supports public credit liquidity, where broad, independent dissemination of information underpins confidence in both pricing and transaction costs. 5. Limited structural sponsorship for two-way secondary flow. Sustainable liquidity is ultimately a function of consistent two-way flow. The evolution of the broadly syndicated loan market is instructive. Liquidity deepened materially as collateralized loan obligations, CLOs, and ETFs created a durable programmatic bid. Private credit lacks an equivalent demand engine at scale. While middle-market CLOs have grown, the ecosystem remains nascent and insufficient to anchor a continuous secondary market. Absent that, trading activity is likely to remain opportunistic rather than structural. In the absence of true liquidity, look for an illiquidity premium. Efforts to improve pricing accuracy in private markets will need to address fundamental issues of transparency, objectivity, and the lack of market-based transactions and price discovery. Given these hurdles will continue to persist, we believe it's unlikely that any meaningful convergence in liquidity will be achieved between private and public markets. With that in mind, investors in private markets should remain focused on receiving adequate compensation, including a premium for illiquidity and credit quality differences. Thank you for listening. That was Daily Pricing is Not Daily Liquidity. For future insights, please follow us on your favorite podcast platform. This episode uses an AI-generated voice. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.